Hello friends, this is Venkatramana once again. Today I just wanted to talk about something which is quite common in the mutual fund industry. Some of the common mistakes which investors can avoid while investing in mutual fund. This is what I would like to speak today. Okay, let me get into that. The first most important criteria while choosing investing in mutual fund is to understand your risk profile, because each person is unique. Each person comes with a different background, different expectations. Their risk profile is completely different. So before investing in a mutual fund, the first thing to look at is you need to ensure that your risk profile is set. Your risk profile will help you to understand how much of risk you can take, how much of volatility you can embrace, and what is that you are looking at the investment, so that whether it can meet your expectations or not. That is a one most important thing which you need to have. And most of the fund managers are having the tool to provide you that, which will be very useful during the journey. Fine. So set your risk profile right. Yeah, the second most important point now is don't chase returns, because most of the investors, what I need is that, especially the young investors, the Robin investors, it's not only new to India, even in abroad, they chase return because they invest in the most fancied investment asset class, or the most fancied fund, or the next big thing. Because always remember, investment returns comes through a different process. It could be on the fund manager's ability, it could be on what is the strategic and dynamic asset allocation, what he is doing, what price he is buying, what is the investment objective of the fund, what is the investment strategy being done. So all this contributes to the return. It is not only the market which determines the return. So please don't chase return, and the last 1 year return will look very attractive, and that is what you need to avoid actually. So whether it is in the debt or equity or international equity, whatever it may be, please don't chase return. Chasing return is the sure shot fall of losing your wealth. It is the most destructive step in not creating wealth. So that is my submission here. So let me get into the third point. Most of the investors within the public domain, they get an important data called as the fact sheet, which provide the point-to-point return. For example, let me tell you, somebody invested in January 1st, 2021, and he stayed invested till December 31st, 2021. It's 1 year. He has invested 1 lakh and the return has become 1,10,000, which is 10% return. So what this point-to-point return says is, only for somebody who has invested on January 1st and stayed till December, he will get 10 returns. What about somebody investing in February, March, April? Will that return will also be same 10%? Here we take a tool called as rolling return. This rolling return, what it does is, it takes the different observations at different point in time and also look at the downside protection and how consistently the fund has delivered return. This is the major yardstick to choose a fund, rather than looking at only the point-to-point return. So this rolling return is an important feature which an investor, it will help the investor to understand, because investor's risk profile is different. So the standard deviation plays a bigger role. So the downside is also need to be considered. So when you investing for long term, we take the standard deviation and the beta, the market volatility also. So always consult a financial advisor or who is good in identifying funds with rolling return. Fine. Okay. Fourth, and I also seen some people investing in funds based on NAVs. They think that NAV is lower, the fund is lower. But please remember, if somebody, a new fund offer which has come at 10 rupees NAV is delivering 10% return, the NAV will be 11. For example, a fund which stayed there for many years, say like the NAV is 1000. If it has delivered 10% return, the NAV is 1100. So it is not the NAV which should matter. What should matter is what the fund manager is buying the securities at what price. That is more important. So don't give importance to NAV. NAV is as longer the fund, the NAV will be higher. And the longer the fund, if the NAV is lower, is a risk, right? And fifth most important thing, which I always remember advocate to investors, is the asset allocation. Asset allocation is something where you will have, in mutual funds itself, you have equity, debt, international equity, commodities, gold, asset allocation, different. In equity itself, you have 10 major categories. Debt has 16 major categories. International equities have 5 major categories, and hybrid also has got 7. So you have to determine what asset class at what time you are entering, how much you are giving, and what percentage you are getting in. This will help you to have an asset allocation, a bucket of products which will fulfill your investment objective and also will give you a better investment experience. So asset allocation plays a very important role while choosing the funds, right? And most importantly, all this will be done by a qualified financial advisor who will do it, because you stay invested. He will monitor your portfolio, he will regulate your portfolio, he will look at any strategic changes to be done, he will help you to reach the goal, and he will suggest you funds based on your risk profile as well as based on your cash flow needs. So I hope these small mistakes can be avoided, and you can always get the help of a financial advisor to onboard your investment journey and be financially independent. Thank you. Look forward to connect with you.